to the big economic story of the day, and this one was a shocker over GDP. Expectations were that it would grow at least 1% in the fourth quarter of 2012. Nope. It actually contracted 0.1%. That is the first time we have seen negative growth since the recession ended more than 3 years ago. So are we headed back into a recession, or is this actually good news? We'll tell you why. Let's talk to our Money Power panel now. Steve Moore is the senior economics writer at the Wall Street Journal. Brian Westbury is the chief economist at First Trust Advisors. And Simon Rosenberg is the president and founder of the New Democratic Network and a former campaign advisor to President Bill Clinton. What a power panel we have here. Steve Moore, let me start with you. Was this a surprise to you?
Yeah, I think it was a surprise to everyone that the number went negative. But you know this, Melissa, as well as anyone, that the number that matters is private GDP growth. Government shouldn't even be part of GDP. And GDP spending government spending actually fell substantially. Military spending was down by over 20%, and that accounted for the negativity. But even if you take out government, we were at a 1.3% growth rate. And Melissa, that just doesn't cut it. That's a pretty anemic number. One other statistic quickly to mention is, there was a big increase in the amount of disposable personal income reported in this report, and I have a suspicion that is a result of the fact, remember you reported on all these special dividends and so on that were paid in the fourth quarter, and I think that showed up in these disposable income numbers, which means we may see a drop-off in those numbers in the first quarter of this year.
Brian, that is a great point, because I had sort of forgot about that. We thought we were going to see this boost because a lot of people were trying to realize wealth under a different tax structure at the end of last quarter. So maybe, maybe this number could have been even worse.
Yeah, well, the income numbers aren't part of GDP. That's the gross domestic income side. We're measuring the production side. And I'll agree with everything that Steve just said, except I want to add in one thing. We had a major drought this year, and in the last 2 quarters, farm inventories have plummeted because of the drought. We just didn't grow as much. And if you subtract both government spending and inventories, the private sector consumption plus business investment was actually up almost 3.5% at an annual rate in the fourth quarter. So this is not a weak report. It's way stronger than the headline number suggests that it was. Second point, to go to this this end of the year income realization. We all remember the Rose Law Firm and Hillary Clinton back in 1992. She took her bonuses early. Our forecast is that we see personal income rise 3% at an annual at 3% alone, not even annualized, just in the month of December. 85% increase in dividends. We already know that. So it's going, clearly we'll pay for that in the first quarter.
Yeah, I assume that would help GDP because people would go ahead and spend some of that money, that if they realize some of that capital, they might make an investment before the end of the year, or they might just spend it on consumption. Simon, what's your take on all that?
Well, I think it's important to see how the market reacted today, which is they sort of shrugged it off a little bit because, as you heard, there's also a lot of countervailing good news in the report. Look, housing is doing better. The weekly jobless claims have been way down. So, we are growing, not fast enough. The economy is doing all right. And the question is going to be now is what does Congress and the president do together in the next few months?
It's negative. I think that's the point of the segment is we're not growing.
I know, but I understand. But the thing is the economy is doing all right. It's not doing really bad. It's not doing really great. It's somewhere in this middling place that it's been really for the last couple of years. That didn't substantially change, and as you heard from the other guests. The key thing now is what is Congress and the president going to do? How do we balance this need for more growth with also deficit reduction in the next few months? That's where the big battle is going to be in Washington, I think.
Well, let me answer that question if I may, Melissa, because I think it's a good one. And I think this is the big political battle. And this is one of the reasons I think that huge fiscal stimulus we had in 2009 was such a expensive mistake, because what we did essentially was we overloaded the economy with all of this deluge of government spending. And essentially what we've done now is we're falling off this kind of cliff that was inevitable. It had to happen. Anytime you have a near $1 trillion increase in spending in 1 or 2 years, you can't keep doing that, borrowing $1 trillion year after year. And that's one of the reasons, that I didn't think it was a very smart thing. All we did was kind of borrow from the future when we had that big stimulus plan in the first place, and that's why GDP may be, a bit lower in the years to come as we drain that out.
Brian, you even question the idea of including government spending in GDP as a calculation, don't you, Brian?
It's the way Simon Kuznets, that's the guy's name, designed the thing long ago. So forget all of that. We know. Just look at Europe. France, for the last 4 decades, averaged 2% real growth and 8% unemployment. We are France right now. The government is so big, it's weighing down the private sector. And the only way we are going to get back to Clinton-type growth numbers like we had in the late 1990s is shrink the government. And it's got to go back to Clinton-size government. That's what we have to do. So I don't agree with Steve that government spending lifted growth. I don't believe that at all. I think that's why we have been.
Let me ask Simon before we go to break, though, because Simon made the point. Hang on. We got lots of time.
We're different from us. We don't have a 75% tax rate here.
That's true. Simon, let me address your point about the stock market, though, because you said if you look at the stock market, obviously people don't think it's that bad, but the stock market and the economy aren't related right now. I mean, the stock market is reacting to what's going on with the Fed, and we had Fed minutes out today. We have the Fed that's out there keeping interest rates so low that they are trying to force investors into the market. I mean, the rally that we're seeing in the market right now is totally disconnected from what's going on with the economy. You disagree?
Well, that's been true, actually, for a long time.
Yes, it has.
But I think part of what I'm saying is that I don't think structurally things have altered that much. We don't have as much growth as we need. And there's too much debt, right? I mean, and we have middling growth. I don't think that's fundamentally changed. And you saw, most major commentators, including my colleagues here, not freaking out about this new number because there was a lot of countervailing, very positive news as well as negative news in this. The point you made, right, is one of the major reasons we went negative is because there was so much cut in government spending, right? And it just reminds us that government spending is not just spending; it's defense jobs, it's firefighters, police, and other things. It's real consequences.
We've got to squeeze in a break, but I love you guys so much. I'm not letting you go home to your families. You're staying right where you are. We're going to take a quick break. We've got more to talk about with our power panel on the other side. Like, could we be following the footsteps of Zimbabwe? It just announced that it had